Hi, you have money. Or you will have money. Eventually. But here's the problem. Money is lazy. If you leave it sitting in a bank account, it does nothing. Actually, it does something worse. It shrinks. That's called inflation. It's the silent thief that eats your purchasing power while you sleep. If a loaf of bread costs $5 today, and inflation is 5%, next year that same loaf costs $5.25. Your dollar didn't change, but its power did. It got weaker. Sad. So you can't just save. You have to invest. Investing is the act of putting your money to work so it makes more money. It's hiring your dollars as employees. Some are hard workers, some are slackers, some are criminals who steal your wallet. Your job is to hire the right ones. But why invest? Why not just buy a slightly larger TV now? Because of compound interest. Einstein allegedly called it the eighth wonder of the world. Or he didn't. He probably said something about relativity. But compound interest is real. It's interest on interest. It's a snowball rolling down a hill. At first, it's small. Then it picks up speed. Then it becomes an avalanche that crushes your financial worries. Here's the math. If you invest $100 at 10% return, you have $110. Next year, you get 10% on $110, not just the original $100. You get $11. Now you have $121. The next year, you get 10% on $121. It accelerates. Over 30 years, that $100 becomes $1,744. Not bad for doing nothing, but if you wait 10 years to start, it only becomes $672. Time is your biggest asset. Start early or start crying later. Okay, so we've got inflation, compound interest, and time. Let's put that in a box and shake it. Boom. You just entered the market. But what are you actually buying? You're buying assets. An asset is anything that puts money in your pocket. A liability takes money out. Your car is a liability. It costs gas, insurance, and repairs. A rental house is an asset. It pays you rent. Stocks are assets. They pay you dividends or grow in value. Bonds are assets. They pay you interest. Let's start with stocks. What is a stock? It's a tiny slice of ownership in a company. If you buy a share of Apple, you own a microscopic piece of every iPhone sold. You don't get to steer the ship. You don't get to tell Tim Cook to make the headphones wired again. But you do get to share in the profits. If Apple sells more phones, the company is worth more, and your share is worth more. If they burn down the factory, your share is worth less. Simple. Why do stock prices go up? Supply and demand. If more people want to buy Apple than sell it, the price goes up. Why do they want to buy it? Expectations. The market doesn't care about what a company did yesterday. It cares about what it will do tomorrow. If investors think Apple will sell billions of phones next year, they buy now. If they think a new law will ban iPhones, they sell. The stock market is a voting machine in the short term, weighing popularity. But in the long term, it's a weighing machine, measuring actual value. But picking individual stocks is hard. It's like trying to pick the winner of the Super Bowl before the season starts. You might guess right. You might guess wrong. Most people guess wrong. Even professionals. Studies show that 90% of active fund managers fail to beat the market average over 10 years. They charge high fees, trade constantly, and still lose to a boring index fund. So what's the alternative? Index funds. An index fund buys a little bit of everything. The S&P 500 index fund buys the 500 largest companies in the US. You don't pick winners. You pick the whole haystack. If one company fails, you have 499 others. If tech crashes, maybe healthcare rises. You're diversified. Diversification is the only free lunch in finance. It reduces risk without reducing returns. It's why you don't put all your eggs in one basket, unless you like omelets and financial ruin. Now let's talk about bonds. If stocks are ownership, bonds are loans. When you buy a bond, you are lending money to a government or a company. In return, they promise to pay you back with interest. It's an IOU. Governments issue bonds to build roads and schools. Companies issue bonds to build factories. You get regular interest payments, called coupons. When the bond matures, you get your principal back. Bonds are safer than stocks. Why? Because bondholders get paid before shareholders. If a company goes bankrupt, the bondholders get whatever is left. The shareholders get zero. So, bonds are the defensive line of your portfolio. They don't grow much, but they don't crash as hard. When stocks panic, investors flee to bonds. This pushes bond prices up. It's a seesaw. Stocks down, bonds up, usually. But there's a catch. Interest rates. When interest rates go up, existing bond prices go down. Why? Imagine you have a bond paying 2% interest. Then the Fed raises rates to 5%. New bonds pay 5%. Nobody wants your 2% bond anymore. So you have to sell it at a discount to make it attractive. Bond prices and interest rates move in opposite directions. It's like a teeter-totter made of sadness and math. Remember this rule. It nukes portfolios. Okay, so we have stocks and bonds. What else? Real estate. You can buy a house, you live in it, or you rent it out. Real estate is popular because of leverage. Leverage is using borrowed money to amplify returns. You put 20% down on a $500,000 house. The bank lends you 80%. If the house value goes up 5%, it's worth $525,000. You made $25,000, but you only put in $100,000. That's a 25% return on your cash. Nice. But leverage is a double-edged sword. If the house drops 5%, you lose $25,000. That's a 25% loss on your cash, and you still owe the bank. Real estate also has costs: taxes, insurance, maintenance, tenants who paint the walls black and adopt 6 raccoons. It's not passive income. It's a part-time job with a mortgage. If you don't want to fix toilets, you can buy REITs, real estate investment trusts. These are companies that own real estate, malls, hospitals, apartments. You buy shares of the REIT like a stock. They're required by law to pay out 90% of their taxable income as dividends. It's easy. It's liquid. You can sell it instantly. You don't have to talk to raccoons. Now let's zoom out. How do you combine these? Asset allocation. This is the most important decision you will make. More important than picking specific stocks. Asset allocation is how much you put in stocks versus bonds versus real estate versus cash. It depends on your risk tolerance and your time horizon. Young? You have time. You can handle volatility. You should be mostly in stocks. 80%, 90%, even 100%. If the market crashes, you have decades to recover. You can buy more when it's cheap. Old? You need stability. You should be more in bonds. 40%, 50%. You can't afford to lose half your portfolio right before retirement. You need income, not growth. There's a famous rule: 100 minus your age equals the percentage in stocks. If you're 30, you're 70% stocks. If you're 60, you're 40% stocks. It's a rough guide. Adjust for your gut. If you check your portfolio every day and sweat, you have too much in stocks. If you check it once a year and forget it exists, you're doing it right. But wait, there's a darker side. Behavioral finance. Humans are terrible investors. We are emotional chaos merchants. We have biases. Loss aversion. Losing $1,000 hurts twice as much as gaining $1,000 feels good. So, we sell when the market drops to stop the pain. This locks in losses. We buy when the market is high because of FOMO, fear of missing out. This buys high and sells low, the exact opposite of what you should do. Confirmation bias. We only read news that supports our beliefs. If you own Tesla, you only read articles about how Elon is a genius. You ignore the articles about how the cars catch fire. Herd mentality. If everyone is buying crypto, you buy crypto. If everyone is selling, you sell. You become a lemming. A rich lemming, hopefully. But usually a poor one. The solution? Automation. Remove yourself from the equation. Set up automatic transfers from your paycheck to your investment account. Buy the same index fund every month, regardless of the news. This is called dollar cost averaging. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, your average cost goes down. You don't try to time the market. You time in the market. Speaking of timing, can you beat the market? Probably not. The efficient market hypothesis says that all available information is already priced into stocks. You can't find a hidden gem because thousands of analysts with supercomputers are looking for it too. By the time you hear about it on TikTok, it's too late. You're the exit liquidity. So, stop trying to be smart. Be consistent. Low-cost index funds, broad diversification, long time horizon, rebalance occasionally. If stocks go up and become 80% of your portfolio, sell some and buy bonds to get back to your target. This forces you to sell high and buy low. It's disciplined. It's boring. It works. Now let's talk about taxes, because the government wants its cut. There are two main types of accounts: taxable and tax-advantaged. Taxable accounts are regular brokerage accounts. You pay taxes on dividends and capital gains every year. Capital gains are profits from selling assets. If you hold for less than a year, it's short-term, taxed like income, high rate. If you hold for more than a year, it's long-term, taxed at a lower rate, 0%, 15%, or 20%. The government wants you to invest long-term, so hold your assets. Don't churn your portfolio. Every time you sell, you create a tax event. Keep it simple. Tax-advantaged accounts are the cheat codes. In the US, we have 401ks and IRAs. A traditional 401k or IRA lets you contribute pre-tax money. You don't pay income tax on it now. It grows tax-deferred. You pay taxes when you withdraw in retirement. The idea is that you'll be in a lower tax bracket when you're old. Maybe. The government gets its money eventually. A Roth IRA is different. You contribute post-tax money. You pay taxes now, but it grows tax-free. And you withdraw tax-free in retirement. If you expect taxes to go up, or if you're young and in a low bracket now, Roth is powerful. It's tax-free growth forever. It's the holy grail. There's also the HSA, Health Savings Account. It's triple tax advantaged. Contributions are tax deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. If you don't use it for medical expenses, it acts like a traditional IRA after age 65. It's the best account in existence. Max it out. But what about fees? Fees are silent killers. An expense ratio of 1% sounds small, but over 30 years it can eat 25% of your returns. Always look for low-cost funds. Vanguard, Fidelity, Schwab. Look for expense ratios under 0.10%. Don't pay for active management. You're paying for underperformance. Now, let's address the elephant in the room. Crypto, Bitcoin, Ethereum, Dogecoin. Is it investing or gambling? It's complicated. Bitcoin is digital gold, scarce, decentralized, no central bank. People buy it as a hedge against inflation and currency debasement. It's volatile. It crashes 80%. It moons 200%. It's a speculative asset. Ethereum is a platform. You can build apps on it, DeFi, NFTs. It has utility, but it's also risky. Regulatory uncertainty, hacks, scams. If you invest in crypto, treat it like venture capital. Only invest what you can afford to lose completely. Assume it goes to zero. If it doesn't, great. If it does, you're fine. Don't put your retirement fund in meme coins. Just don't. What about other alternatives? Gold, commodities, art, wine. These are non-productive assets. They don't produce cash flow. They don't pay dividends. You only make money if someone else pays more for them later. This is the greater fool theory. Gold is shiny. It's a store of value. Over the long term, stocks crush gold. Stocks represent human productivity. Gold represents fear. Bet on productivity. So how do you actually start? Step 1. Get out of debt. High interest debt, credit cards, is a guaranteed negative return. Pay it off. It's the best investment you can make. Step 2. Build an emergency fund. 3 to 6 months of expenses in a high-yield savings account. This prevents you from selling investments when life happens. Step 3. Open a brokerage account. Step 4. Buy a low-cost total market index fund. Step 5. Set up automatic contributions. Step 6. Wait. Waiting is the hardest part. You will see bubbles. You will see crashes. You will see your neighbor make millions on a stock you didn't buy. You will feel stupid. You will feel anxious. This is normal. Stick to the plan. The market has historically returned about 10% per year on average, not every year. Some years it's minus 30%, some years it's plus 30%, but over 20 years it's up. Always up. Why? Because the economy grows. Companies innovate. People work. Productivity increases. We invent better things. We solve problems. The stock market is a bet on human ingenuity, and so far that's been a winning bet. But beware of scams. If someone promises you 20% returns with no risk, run. It's a Ponzi scheme. Bernie Madoff didn't invent fraud, but he perfected it. If it sounds too good to be true, it is. There is no risk-free high return. Risk and return are linked. You can't have one without the other. Also, beware of financial advisors who charge 1% of your assets. On a $1 million portfolio, that's $10,000 a year. For what? Buying index funds? You can do that yourself. Hire a fee-only advisor if you need complex planning. But for most people, DIY is better. Keep it simple. Let's talk about valuation. How do you know if a stock is expensive? PE ratio, price to earnings. If a stock costs $100 and earns $5 per year, the PE is 20. You're paying 20 times earnings. Higher PE means higher expectations. Tech stocks have high PEs. Utility stocks have low PEs. Compare PEs within industries. Don't compare Apple to a water company. But valuation doesn't matter as much for index funds. You're buying the whole market. You don't care if one company is expensive. You care about the overall trend, and the overall trend is up. What about dividends? Some people love them. They provide cash flow. You can reinvest them to buy more shares. This accelerates compounding. Dividend growth investing is a strategy. Buy companies that raise dividends every year. It's conservative. It's safe. But total return, price appreciation, plus dividends is what matters. Don't chase high yields. A 10% yield often means the stock price is crashing. It's a yield trap. Okay, let's look at the global picture. Should you invest internationally? Yes. The US is great, but it's not the only country. Europe, Asia, emerging markets. They offer diversification. Sometimes they outperform the US. Sometimes they don't. A global index fund covers it all. You bet on the world, not just one country. Geopolitical risk is real. Wars, sanctions, trade barriers. Diversify across borders. What about ESG? Environmental, social, and governance investing. Some funds exclude oil, tobacco, weapons. They focus on sustainable companies. Do they perform worse? Studies are mixed. Sometimes they do, sometimes they don't. It's a personal choice. If you want your money to align with your values, go for it. Just know you might pay slightly higher fees or have less diversification. Finally, let's talk about the end game. Retirement. How much do you need? The 4% rule. If you withdraw 4% of your portfolio in the first year of retirement and adjust for inflation thereafter, your money should last 30 years. If you spend $40,000 a year, you need $1 million invested. $40,000 divided by 0.04 equals $1 million. It's a rule of thumb, not a law. Market conditions vary, but it's a good target. To get there, you need to save. Save 15 to 20% of your income. Increase it every time you get a raise. Lifestyle creep is the enemy. You get a raise, you buy a nicer car. You stay broke. Keep your lifestyle flat. Invest the difference. Your future self will thank you. Your present self will hate you. Ignore your present self. He's impulsive. So, what have we learned? Inflation eats cash. Compound interest builds wealth. Stocks are ownership, bonds are loans. Diversification reduces risk. Index funds beat most professionals. Fees kill returns. Taxes matter. Use tax-advantaged accounts. Behavior is your biggest enemy. Automate. Time in the market beats timing the market. And there is no get-rich-quick scheme, only get-rich-slow. Investing isn't about being smart, it's about being disciplined. It's about controlling your emotions. It's about understanding that wealth is a marathon, not a sprint. You don't need to be a genius. You just need to start and keep going. That's investing. All of it. Well, almost all of it. Explained fast. Okay, this was really hard and took ages to make. But if you got something out of this video and would like a part 2 on advanced strategies, vote with a thumbs up. If this video gets like 1,000 likes, I'll have to make part 2 because that's how finance on YouTube works.